Hello everybody. Continue our bunch of videos and webinars related to credit management, credit risk and accounts receivable. Today our topic would be bad debt. Normally companies used to say that this is not really an issue. Companies managers used to say, when they speak with auditors, when they speak with their owners and among themselves, they say, yeah, we do have bad debts, but they're tiny. They're really small, and they represent the vanishingly small part of our sales. Let us use a pretty simple example from real life. These are the numbers I took from annual report of quite big Swiss company. It's a publicly traded company in Switzerland. As you can see, bad debts, which are 0.6 million Swiss francs, are really very difficult to see if we compare them with sales. But sales is not the only comparison for the bad debts. We know that bad debts really affect company's profit. So let's compare these bad debts with the net profit of a company. Here, I took very realistic engineering proportion. Here, we would say that 0.6 million is already seeable. It is not yet as big. It is not yet that quite material, but we can already see that. The real story behind that is a little bit more important. We all know that bad debts are not affecting profit in terms of in accounting terms directly. We know that bad debts provision is affecting the company's profit. So if we compare, or if we take into account bad debts and bad debts provision, we're going to have absolutely different picture. Let's have a look. So here we see that the provision of bad and doubtful debts of a company is already $20 million, and this is already, let's say, sizable. So the debts and doubtful debts represent really can be really an issue. And if we move a little bit further and have a look, not in accounting perspective, but in management perspective, we will have absolutely different picture. Here, we simply add bad debts provision to the profit and see what profit company could have if it would take care of its bad debts. And we can easily see that the company's profit can have significant 30% potential of profit growth just because of taking care of bad and doubtful debts. I don't say this 30% can be fully utilized, but significant part of that could be a big saving and bigger achievement and great contribution to company success. Now, as we know, as we already see in that bad debts are important, let us now see what can we do about that. We all know that bad debts are coming to the company in two cases. When we advance payments to our suppliers and when we extend credit terms to our customers. One could say, okay, if it is that risky, why do we do that? The problem is we don't really manage risks themselves. We take risks because we would like to meet and we would like to utilize fully an opportunity. As such, we have always to find the balance between risk and opportunity. So we have to think about risk of losing a finance, a losing of bad debt, risk of bad debt, and at the same time we have to consider risk of loss of profitable sale. So we need to find a balance, and this Rob Walker is actually my favorite hero, who is really a business manager standing between forge and the hammer, and well, we have to do it if we would like to do business properly. What can we do before we consider how we can find this balance? We need to see what are the risk scenarios or the ways losses come to our business. First loss is fraud. Yeah, it still happens. You ship goods to a customer or advance payments to a supplier, and this would be the last day you've seen them. The people you're dealing with and your money or your goods. This is really a fraud. This is dealing with a fake company. It's a crime, and but it still happens, and companies still lose money on that. Less and less, but continue to. Another scenario is country risk. I would say this is the whole bunch of different scenarios related to countries, to economical situation in the country of your counterpart. It obviously mostly affected it all mostly affects operations concerned with import and export of the goods. Again, if you are involved in export or in import business, you have to consider that just as obvious. For other cases, it would be good to see how economical situation in the country affects your customer. We're going to consider that in details later. The third scenario is actually the most common, at least in literature, which is normally called credit risk. It's a risk of insolvency. When your supplier or your customer has financial difficulties, and when this company actually goes bust. We'll have a look what can we do about it, but this is the classical scenario of the credit risk, the bankruptcy. And the last one is long-term fraud. It's most difficult to manage. Very dangerous scenario. It looks exactly as insolvency, but this is the insolvency made by companies' management or owners. Well, it is again as a fraud, as a short-term fraud. It's still a crime, but it still happens. Now, let's have a look. What can we do about these risks? First of all, let's consider fraud. Fraud itself is the only risk which does not presume, or management of which does not presume any tolerance. So it presumes zero tolerance to itself, meaning that you cannot balance risk, dealing with fraudsters. It's just zero tolerance. Every doubt needs to be verified before the transaction, because otherwise, as I explained, you simply send payment and you never see goods and never see your counterpart. Never rush with decision because fraudsters and people who commit fraud normally push on psychology. They say this is rare opportunity, this is only for you, and you have to take decision very quickly. Again, this is done just to make sure you don't verify data, you don't verify the transaction. So if you would like to prevent really fraud, you need to take your time for the verification and verify the data declared by company through the independent sources of information. It could be Dependent sources could be like state registers, like independent information providers, business reports, whatever you find appropriate. But you have to verify and make sure that if the company declares this or that, say, company code, this company code should be should be registered in the state register under this name with that address, and if there is a discrepancy, you ask your counterpart for the explanation. It should not become too difficult, especially taking into account currently existing compliance procedures and requirements. You do two things at the same time. You do compliance, you do your fraud prevention, and you put yourself on the safe side. Again, zero tolerance to all the doubts. Next risk is country risk. Well, as I said above, country risk is the whole bunch of scenarios from risk of convertibility, political action, changes of legislation, and so on and so on and so on. But there is a very simple way to assess country risk. You may use ratings by major rating agencies. Obviously, there is a lot of criticism against the ratings, against the way they work, against the ratings they apply to different countries and so on. But in general, they still do very good job in terms of assessment of the situation within the economy, and their rating and changes to their rating can be a very good can serve as a very good indicator to the economical situation within the country. And again, if you do a very serious transaction for big amount of money or it is long term, no one prevents you from having deeper look into details of what are the recent development of the economy, what are the trends, where do they go, and take a balanced and informed decision. But if you got 100, 150 countries in your portfolio and you need to review them on monthly basis or weekly basis or quarterly basis, it's pretty simple to simply use to just take rating or three rating of major agencies and take either average of them or best of them and see what are the changes to the economy and to the political situation in the country. Again, just to put yourself on a safe side. Now we move to insolvency. Insolvency or risk of insolvency or risk of bankruptcy or risk of payment default, as you prefer to name them, is normally assessed by companies' financial strength. So majority of, or if not all of the methodologies to assess insolvency risk presume assessment of companies' financial statements. You take financial statements. Here on the slide you can see 5 years you may use, 3 years if available, but you need to avoid or try your best to avoid the major mistakes companies normally do. First of all, you need to analyze financial statements of the exact legal entity you are dealing with. So if you are dealing, for instance, with, I don't know, Coca-Cola Czech Republic, you should not assess Coca-Cola's group financial statements because this is the owner of Coca-Cola Czech Republic, but based on limited liability concept, owner is not liable for the debts of the company. So finances of the legal entity you're dealing with is exactly the money you can count on. So don't be misled by the strength of the owner. And second major mistake companies normally used to do is that they analyze the customer or the supplier at the beginning of the transaction when they sign the agreement, and then they forget about it. So they are dealing with customers for years, sometimes for tens of years, and don't reanalyze, don't review their creditworthiness assessment. Well, simple fact known to every financier, to every credit manager, to every treasurer, and to every financial analyst is that the financial strength of the company changes nearly every single day. Therefore, uh, when the company you sign agreement with 5 years ago is not the same today, and you need to see trends, and you need to see the recent development in their financial situation to make sure you are still dealing with a credit-worthy customer. Uh, there is also a third mistake. Uh, when you analyze or do review of financial statements. Some companies believe that this reassessment requires immediate action, immediate review of credit limit or payment terms, or refuse of providing credit, which is I think this is the biggest mistake which companies normally do. Credit assessment needs to be a facilitation material for the discussion between the two companies. When you see that financial strength of your supplier or your customer is going down, is changing, you need to go back to them and sit with them and talk and find common ground and find the solution for this difficult situation. Only like that. No immediate action is. I think this is the most dangerous thing you can do with with the credit analysis. And the next risk is long-term fraud. Uh, Previously I used to say that long-term fraud could not be predicted. There is nothing you can do about it. It's not completely like that. Obviously, as long as we cannot manage and we are not in full control of our counterpart's business, like as a business of our supplier, of our customer, we don't know what decisions are taken by their management, what decisions are taken by their owners, how the situation is going on, in that immediate moment of business, immediate moment of management. There would be no control for us, so we cannot really, affect these decisions. But we may pay attention to unusual behavior, to changes into the unusual, unexpected directions. For instance, your customer is you normally orders 5,000 items of goods per month, and suddenly they ordered 15,000, 20,000, and then they don't ask for extension of payment terms. Price is not an issue. That could be a sign that they need some additional finance for something, and you need to be careful. You need to verify. Don't say no. Don't say yes. Ask questions. Uh, Regularly perform business reviews, again, to ensure predictability of business, predictability of operations, and mutual understanding of what you are doing together. And also this would be a prevention of long-term fraud. So if there is a sudden change in their business, you would know that. And pretty simple advice: try to meet your major customers and major suppliers, especially those you provide credit to, in person. Look them into eyes, meet them face to face, and see what's, their attitude would maybe a mark for you to, to become a little bit more careful, to pay attention to other details and see what's going on. This might be helpful to avoid long-term fraud. Again, make sure don't go too far, don't do too much, don't try to make an overkill, because this might become a paranoia. And paranoia, even if it exists, must be really productive. So don't go in that direction too far. And that might create another difficult thing. So with all of the risks, we might say, okay, it's risky environment and this everything, there are lots of risks. Why do we bother ourselves with all of that assessment, with everything, if we can easily pass these risks to a bank, to insurers, to any other provider, simply transfer the risk to somebody else who's supposed to take care of. Well, it would be good solutions if this risk transfer can be done for free. Unfortunately, this is not the case. Risk takers and the solutions providers always do it at the cost. Obviously, the market is full of such solutions. Majority of us do know that there are bank guarantees, insurance, LCs, standby letter of credit, factoring, all of that. But everything comes at cost. And the real story we have to do about managing the bad debts and managing the risks is actually finding the balance among the three major weights. It would be risk, it would be opportunity, it would be cost. Because we all know that there are lots of cases in modern business where companies refuse, for instance, credit insurance because annual premium paid for insurance is significantly exceeding bad debts. Bad debts practically incurred. So you have to you have to be very careful about that and look at every instrument you use and the size of the instrument you use really seriously. So what can we do? What can we do about bad debts? We always check new customers through independent sources and never tolerate fraud. Continuously monitor changes in countries, so we see the changes in economical and political situation of countries where our customers operate in. We evaluate credit worthiness and review it on a regular basis, minimum and annual basis. We keep close eye on unusual behavior of our counterparts, and we carefully choose and use security instruments. Thank you very much for your attention. Please don't hesitate to comment this video, like it, put your likes if you like it, and don't hesitate to share it with your colleagues and friends, and stay tuned. New videos are coming. Thank you very much for your attention.